A regional conflict reshapes global financial markets, not through direct damage, through fear of what comes next. So here's the question that keeps investors up at night. How does fighting thousands of miles away end up on your fuel bill? The Middle East conflict that began in late 2023 has now stretched past the 6-month mark. Reuters documented how that sustained period of war rippled outward, not just across the region, but into global energy prices, shipping lanes, and investor sentiment worldwide. The story wasn't just about missiles and borders. It was about how a conflict in one corner of the world quietly reaches into the financial lives of people who will never set foot near the fighting. And the mechanism that makes that happen is older, more reliable, and more ruthless than any single war. Stay with us, because by the end, you'll know exactly how to read the next one when it starts. Here's the core idea. Markets don't price what's happening. They price what might happen next. That distinction sounds small. It is not. When conflict breaks out in a region that sits astride major oil shipping routes or energy infrastructure, traders and institutions don't wait for a tanker to be hit or a pipeline to go dark. They start asking, what if it does? That question alone is enough to move prices. This is called geopolitical risk pricing, and it's one of the most powerful and least understood forces in financial markets. It doesn't require an actual supply disruption. It requires only a credible threat of one. Think about that for a moment. The fear of a shortage can cost you money at the pump before a single barrel of oil goes missing. Markets are forward-looking machines. They're always trying to get ahead of reality. And in a conflict zone, reality can change overnight. The Middle East matters so much to global markets for one specific reason: geography. A significant share of the world's oil supply moves through a handful of narrow maritime choke points in that region. When those routes feel threatened, the whole system twitches. Energy prices are the first to move, but they are rarely the last. Think of it like a city's water pressure. Most of the time, water flows freely and nobody thinks about the pipes. But the moment someone reports a crack in the main line, even if nothing has leaked yet, people start filling buckets. Prices on bottled water jump. Plumbers charge more. The threat alone changes behavior, and changed behavior changes prices. Geopolitical risk works exactly the same way. The pipes are shipping lanes, oil fields, and the terminals that move energy from producers to consumers. The crack in the line is a conflict that puts those routes at risk. Traders are the people filling buckets, not because they're panicking, but because their job is to price in uncertainty before it arrives. Here's how that moves through the system. First, oil markets respond. When routes through a volatile region look less safe, the cost of insuring a ship rises. Disruptions of this kind tend to lift what's called war risk insurance premiums, the extra cost carriers pay to move cargo through danger zones. Those costs get passed along. Freight becomes more expensive. Energy prices follow. Then something broader happens. Investors get nervous about risk in general. When there's a shooting war near critical infrastructure, money tends to move away from assets that feel exposed and toward things that feel safe, typically government bonds, gold, or the US dollar. That shift in sentiment can push up borrowing costs across entire economies, not just in the region at war. And here's the part most people miss. The effect doesn't end when the shooting slows. Uncertainty can linger for months. Shipping companies reroute. Long-term contracts get repriced. Infrastructure investment in the region stalls. The crack in the pipe keeps affecting water pressure even after someone slaps a patch on it. That's the mechanism. Fear prices in first, reality catches up second, and the effects echo long after the headlines move on. So where does this land in your actual life? Start at the fuel pump. Oil is priced globally, which means a conflict near a major shipping choke point can push up what you pay to fill your tank, even if your country imports none of its oil from that region. Energy is one market. When the price moves, it moves everywhere. Then, follow the energy cost into everything else. Trucks that move goods burn diesel. Ships that carry imports burn fuel oil. Factories that make products use natural gas or electricity. When energy gets more expensive, all of those costs rise together, and eventually they show up on a shelf, in the price of groceries, appliances, or clothing. That's the transmission belt between a faraway conflict and your cost of living. There's also the borrowing channel. When geopolitical tension rises sharply, investors often demand higher returns to hold longer-dated government debt because the future feels less predictable. The U.S. 10-year Treasury yield, a benchmark that influences mortgage rates, car loans, and business borrowing across the economy, was sitting at 4.66% as of late August 2026. Rates at that level already make borrowing expensive. A sustained geopolitical shock that pushes bond yields higher tightens that pressure further. On your mortgage payment, on your credit card rate, on your landlord's financing costs that eventually find their way into your rent. And there's a subtler cost. Business investment slows. Companies operating near conflict zones delay expansion. Supply chains that run through those regions get redesigned at great expense. Those costs don't disappear. They get built into the price of whatever that supply chain was producing. War has a very long invoice, and most of it gets sent to people who never saw the fighting. So back to the question from the top. How does fighting thousands of miles away end up on your fuel bill? Here's the answer. It travels through the mechanism of geopolitical risk pricing, the market's habit of charging for uncertainty before the worst actually happens. The Middle East conflict is one sharp example of a pattern that repeats across history. A war near critical infrastructure doesn't have to destroy anything to move prices. It just has to make the future feel less certain. And markets, which run on probability, respond immediately. What makes this pattern so important to understand is that it doesn't require a particular side to win or lose. It doesn't require a diplomatic resolution or an escalation. It just requires the conflict to persist. Because persistence is uncertainty, and uncertainty is a cost. That cost flows through energy prices, through shipping rates, through bond markets, and through the everyday prices you pay for things that had to be made, moved, or financed. The smart move isn't to predict how a conflict ends. It's to understand which parts of the global economy are exposed to the mechanism, and why. Because the mechanism doesn't care about the politics, it cares about the pipes, and whether the water is still flowing. If this helped you see how geopolitical events connect to your financial life, subscribe to Investors Club Global. Every video on this channel works the same way. Real news, timeless mechanisms, no hype. Hit the bell so you don't miss the next one.